On July 6, 2026, Strategy disclosed something the market was not used to seeing. It sold 3,588 Bitcoin, roughly $216 million. The company, built around Michael Saylor's never sell identity, had just sold the largest amount of Bitcoin in its history. And that is only the surface of the story. Because this sale was not really about one transaction. It was about a machine. A machine built on Bitcoin, preferred stock, dividend obligations, and the belief that capital markets would always stay open. Welcome to BlockDocs, where we strip away the noise to expose the raw truth of crypto and global finance. Hit subscribe to track the money with us, and let's get straight to the story. For years, Michael Saylor built one of the most powerful public brands in Bitcoin around a simple idea. Strategy would never sell. The company would borrow. It would issue equity. It would raise capital. And it would use that capital to accumulate more Bitcoin. The last time the company had meaningfully sold Bitcoin was back in December 2022, in the middle of a brutal market collapse triggered by the FTX implosion and credit contagion across crypto. After that, the message became simple. Only buying, never selling. Strategy called the model net aggregation, not just owning more Bitcoin, but trying to grow Bitcoin per share. By mid-2026, Strategy still held 843,775 Bitcoin, the largest Bitcoin stack held by any public company on Earth. But at the end of May 2026, the first crack appeared. The company sold 32 Bitcoin, just $2.5 million. Not enough to shock the market, not enough to challenge the whole narrative. It was framed as a small sale to support a dividend payment on one of Strategy's preferred securities. Saylor's framing was not surrender to JMIT, was obligation, a commitment to preferred shareholders. Most people ignored it, because 32 Bitcoin was tiny compared with a stack of more than 843,000. But that was the signal. The first sale was not important because of its size. It was important because it proved Bitcoin had entered the payment schedule, and 6 weeks later, the next sale would be more than 100 times larger. This was not Strategy selling, because Bitcoin had reached a euphoric price target. This was Strategy selling below its own average cost basis. So the obvious question is, why? You have to stop thinking of Strategy as simply company that buys Bitcoin. Strategy is now a Bitcoin treasury wrapped inside a credit machine. It has issued a stack of preferred and digital credit securities, STRF, STRE, STRK, STRD, and STRC. These instruments are not all the same. Some have fixed coupon-like features. STRC is variable rate preferred stock. Its dividend rate can be adjusted monthly with the stated goal of helping it trade near its $100 par value. As of the latest Strategy disclosure, STRC's annual dividend rate had been pushed to 12%. That is not a small detail. It tells you the company is trying to keep demand alive for the credit layer it built around Bitcoin. Across the company's preferred dividends and interest expense, Strategy has roughly $1.76 billion in annual expected obligations. This is the key number, not because it means Strategy is collapsing tomorrow. It does not, but because it changes the nature of the Bitcoin strategy. Bitcoin is volatile. Dividend schedules are not. Bitcoin can wait. Payments cannot. So when Strategy sold Bitcoin at around $60,200 per coin, the signal was not Saylor lost faith. The cleaner signal was this. Strategy's Bitcoin stack is no longer only a reserve asset. It is now a liquidity source. And once an asset becomes a liquidity source, never sell becomes harder to defend. This is where the story becomes genuinely important. Not because one sale destroys Strategy. It does not. But because the sale reveals the loop underneath the company. STRC is designed around a simple idea. A preferred stock with a $100 target value, paid in cash, adjusted through a variable dividend rate. But when STRC trades below par, the machine gets harder to run. Why? Because when a preferred stock trades below its target value, issuing more of it becomes less attractive. New buyers demand more yield. Existing holders feel more risk. The company may need to increase the dividend rate to support the price. And if the market still refuses to price it near par, the capital raising engine weakens. This matters because Strategy's model depends on capital markets staying open. When capital markets are open, Strategy can issue securities, raise cash, buy more Bitcoin, and maintain the image of a constantly growing treasury. But when the securities trade weakly, the model changes. The company must protect confidence in the credit layer. That is why the BTC monetization program matters. Strategy has authorized itself to sell up to $1.25 billion of Bitcoin under that program. The program does not mean Strategy must automatically liquidate Bitcoin. That would be too strong. But it gives the company permission to use Bitcoin sales as a liquidity tool. This is not forced liquidation in the classic sense. There is no automatic margin call in this story. The pressure is subtler. It is structural. Strategy built a machine that works best when Bitcoin rises. MSTR trades at a premium, and preferred securities can be issued near par. When those conditions weaken, the machine does not stop immediately, but it starts feeding on the asset it was built to accumulate. Now, here is the part that keeps this from becoming a simple anti-Saylor story. Because if you only say Strategy sold Bitcoin, you miss the balance. The company still holds 843,775 Bitcoin. It still has a massive Bitcoin treasury, and according to Strategy's own capital framework, it has a USD reserve of approximately $2.55 billion. That reserve represents around 17.4 months of coverage against current annual expected preferred dividends and interest expense. It means this is not an immediate solvency crisis. A weak script would say, Strategy is collapsing. That is too simple. The better read is, Strategy has bought itself time. But that time is not free. It depends on reserves, capital markets, Bitcoin prices, and the market's willingness to keep funding the structure. This is also why the buying and selling at the same time paradox matters. In previous months, Strategy was still buying billions of dollars of Bitcoin. It could sell a small amount to fund obligations, then raise capital and buy more. It could look like accumulation and monetization at the same time. That contradiction is the story. Strategy can still be at a Bitcoin accumulator, and it can still be a Bitcoin seller. Both can be true once the balance sheet becomes complex enough. So this is not a company abandoning Bitcoin. It is a company that turned Bitcoin into the center of a financial structure. And financial structures do not care about slogans. They care about cash flows. So, here is the question that actually matters. Did Michael Saylor's conviction in Bitcoin change? Probably not. Saylor can still believe Bitcoin is the superior treasury asset. Strategy can still hold more than 843,000 Bitcoin. The company can still call itself a net aggregator. None of that has to be fake, but conviction is not the same thing as structure. An individual can say, I will never sell. A company with preferred stock, interest expense, reserve policies, dividend expectations, and repurchase authorizations lives inside a different reality. The payment schedule does not care what you believe. The market does not care what your slogan was. And a balance sheet does not care how iconic the founder's conviction became. This is the cleanest way to read the July sale. Strategy did not sell because Bitcoin was no longer sacred. Strategy sold because Bitcoin had become usable. That is the real break, not the sale itself, the status change. Bitcoin moved from untouchable treasury asset to an authorized balance sheet liquidity. This doesn't mean Strategy is dead. This doesn't mean Saylor stopped believing in Bitcoin. And this doesn't mean the entire Bitcoin stack is about to be dumped. But it does mean never sell has been structurally rewritten. The dangerous part is not that strategy sold once. The dangerous part is that selling Bitcoin is now part of the machine. And once that door opens, the market's next question is no longer, will strategy ever sell? It is, how many times will the machine need Bitcoin to become cash? This is the warning sign retail investors often miss when they copy a leveraged strategy. Borrowing against Bitcoin can look intelligent in a bull market. It can look like financial engineering. But if the asset falls, income disappears, or refinancing gets harder, the structure can force behavior that contradicts the thesis. This is not the first time leverage has turned a long-term believer into a forced or pressured seller in crypto. It happened with funds, lenders, miners, exchanges. And now, in a more sophisticated form, the pressure is appearing around the most famous corporate Bitcoin holder in the world. Now the market is learning that even never sell can become complicated once it is wrapped inside public company finance. What do you think is the bigger red flag here? The $1.76 billion in annual expected dividends and interest? Or the fact that Bitcoin has now become an authorized liquidity tool on Strategy's balance sheet?